Finance and accounting are both extremely important business functions, as without them, there may be no way to know if the organization has the funds to continue operations. One key output of the finance and accounting function is the balance sheet, the income statement, and the statement of cash flows. We will need to understand each of these, how they are similar, as well as the key differences. The balance sheet is essentially a snapshot representing the state of a company's finances, basically what it owns or owes, as of the specific date of the publication. A balance sheet reports a company's assets, liabilities, and shareholders' equity at a specific point in time and provides a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. Analysts will use balance sheets in conjunction with other financial statements to calculate financial ratios. The balance sheet adheres to the following accounting equation, where assets are on one side and liabilities plus shareholders' equity are on the other. Both sides should balance out. The formula is intuitive. A company has to pay for the things it owns, which are the assets, by either borrowing money, which also means taking on liabilities, or taking it from investors, which would be issuing shareholders' equity. There's also the income statement. Unlike the balance sheet, the income statement covers a range of time, which is usually a year for financial statements and a quarter for quarterly financial statements. The income statement provides an overview of revenues, expenses, net income, and earnings per share. It usually provides 2 or 3 years of data for comparison. The income statement uses a basic formula and calculation. Net income will equal revenues minus expenses. The statement of cash flow is a statement that measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund continuing operating expenses. A cash flow statement is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. The cash flow statement measures how well a company manages the cash position, how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement provides a different view of cash and complements the balance sheet and income statement. It's also been a mandatory part of a company's financial report since 1987. We must also understand the various budgeting options an organization may use to both budget and forecast key financial considerations. Incremental budgeting takes last year's actual figures and then adds or subtracts a percentage to obtain the current year's budget. It's the most common method of budgeting because it's simple and easy to understand. Incremental budgeting is appropriate to use if the primary cost drivers do not change from year to year. Activity-based budgeting is a top-down budgeting approach that determines the amount of inputs required to support the target or outputs set by the company. For example, a company sets a target of $100 million in annual revenues. The company will first need to determine which activities are needed to be undertaken to meet that sales target, and then find out the cost of carrying out such activities. Value proposition budgeting is really more so a mindset about making sure that everything included in the budget delivers value for the business. Value proposition budgeting aims to avoid unnecessary expenses. In value proposition budgeting, the person setting the budget considers the following questions. Why is this amount included in the budget? Does this item create value for our customers, staff, or other stakeholders? Does the value of the item outweigh its cost? If not, then is there another reason why this cost is justified? Our final option, and one of the most commonly used budgeting methods, is zero-based budgeting. This starts with the assumption that all department budgets are zero and must be rebuilt from scratch. Managers must be able to justify every single expense. No expenses are automatically okayed. Zero-based budgeting is very tight, aimed to avoid any and all expenses that are not considered absolutely essential to the company's successful or profitable operation. This kind of bottom-up budgeting can be a highly effective way to shake things up. The zero-based approach is good to use when there's an urgent need for cost containment. Zero-based budgeting is best suited for addressing discretionary costs rather than essential operating costs. However, it can be extremely time-consuming approach, so many companies only use this approach sparingly. Beyond finance and accounting, every organization, regardless of size, has basic key business functions, such as sales and marketing, operations, and information technology, to name a few. Larger organizations will have even more functions, such as customer service and relations, research and development, or possibly even a business line like quality assurance. They each have a connection and collaboration associated with the human resource function. As HR professionals, we must be able to form partnerships with their organization's key business functions to truly understand the functional areas and be a valuable strategic business partner. Research and development, often known as R&D, is the process by which a company works to obtain new knowledge that it might use to create new technology, products, services, or systems that it will either use or sell. Sales and marketing is a function that's normally the revenue generator in an organization. It's responsible for selling the organization's service or product, and the marketing function has responsibilities for promoting, pricing, and locating or identifying the customer base. Operations is considered the heartbeat of the organization. Operations will create the goods or services, acquire the resources, and ensure the customer receives those goods or services. 5 key concepts drive operations: capacity, scheduling, inventory, standards, and control. Information technology, or IT, is the brain of today's organizations. The system, tools, and information required for all the business's key functions to do what they do are dependent on the responsibilities of IT.